Thursday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you and a pleasure to be with one of my two normal co-hosts, Dwight Millard of Highlands Mortgage, joining us. Corey Edge is traveling today. How are you, my friend?
I'm doing fantastic, John. How are you?
Smiling more than you, my friend, as you're going to tell us
I
with these
don't know.
mortgage rates.
I'm smiling pretty good.
I'm smiling with the records of the market today, the various mortgages that have now broken below the ever so important 6% mark. Not the big one yet. Not the big one. We got a ways to go there.
No. Yeah.
But overall, it's good. Thank you, my friend. I appreciate you asking. All right, Dwight, we've got a lot of things to talk about, so we're going to cut the chit-chat and we're going to get right down to business this afternoon. Let me tell you what we have lined up. Mortgage rates, right? Mortgage rates. They fell to the lowest level in nearly a year this week. Widespread expectation, of course, is we're going to go into more detail. The Fed's going to give us an interest rate cut next week, next Wednesday, 11 o'clock. We will know for sure. So that is the main reason. 30-year average, fixed mortgage average, about 6.35%. But today, that's even a little bit lower. So Dwight's got some good news on that. And again, we're back to levels we haven't been at since about October. Okay, so we're getting some, almost, like I said, going back almost a year now. Now, all sounds good and everything, right? But how about this? There's still one key factor that is keeping buyers at bay, even though, as Dwight so correctly said before, John, it's not all about the rates anymore. There's another factor, and we're going to share with you today what that other factor is that could keep, like I said, a bit of concern and maybe some declining prices when it comes to real estate. And that one topic, I'm just going to let the cat out of the bag, Dwight, is affordability. And you have said this all along, that even if rates do adjust lower, which we don't, there's no guarantee that they will next week when we get the Fed interest rate cut. I want to go through that scenario again. There's only so much you can do as the mortgage banker in regards to qualifying them because of the price of the home, the affordability.
Yeah. Well, I was hoping you didn't let the cat out of the bag, because I was going to say, we all know it. We all feel it. It's not a surprise of what it is. We just maybe don't know, what is lurking out there that holding everybody back. But John, I mean, the reality is, whether I can qualify you or not, you still got to make that payment.
Yes.
Along with your health insurance, along with your daycare, along with everything else that's in your stew of funds, or expenses. And so it has been a hot topic for what now? 5 years?
Yes.
Affordability, or if not longer, right?
Right.
And, I don't know that you see a lot of movement on, big movement. They come up with these little fancy products and things like that, but that's not solving the problem. That's just a Band-Aid right now. I don't know what the cure is, other than, all the government entities and everything. You just drive the cost of that to build that unit down.
Well, I hate nothing more, and you know this, Dwight. You and I have been together since 2008, and you know what I stand for, and that is, I hate telling the audience about a problem with no solution.
Mm-hmm.
And I want to kind of go through some of these solutions that I've been thinking about recently. We've touched on a few of them in the past, and see if any of these are viable. And I'm just going to give a little hint of where I'm frustrated, and that is, why can the U.S. government and the Trump administration spend billions and billions and billions of dollars on this program or that program, or, on immigration and ICE? And I mean, name your favorite program. They're spending hundreds of billions of dollars. But yet one of the most driving forces of our U.S. economy is the housing market.
Mm-hmm.
No one has done. The Biden administration didn't do anything, and we so far haven't seen the Trump administration do anything other than push for lower interest rates, which, again, as we'll explain throughout the program, that's only going to go so far.
Yeah.
We have this underlying issue, and that's why you and I wanted to talk about this today, which is the affordability. Where are the incentives to whatever? I don't care if you're a mom and pop, custom home builder, or you're one of the publicly traded companies. Where are some incentives for these companies to go build more homes? It is very simple, in my opinion. It is a supply and demand issue, right? We can't control inflation. We can't control what it's going to cost to frame a house or pour the concrete. But what we can do is offer incentives as a government. If this is a big issue to the economy, which we know it is, the government is the only deep pockets that can step in to help all these people out there that cannot afford. I mean, I saw a stat today as I was preparing for this topic. Only 23% of the renters in the U.S. can afford a home. Only 23%. I mean, think if you could just unleash some type of a government-backed program for these builders to offer more homes. And again, it's going to be supply and demand. If all of a sudden tomorrow some program's announced, and I don't know, I'm going to pick a hypothetical number. Let's say 3 million new homes can be built. Do you really think our median price is going to remain at 600 plus thousand? No, it's going to come down, which doesn't feel good for a homeowner, but it does feel good for all those people that are just like,
Yeah.
man,
Yeah.
I've got the income, I've got the credit score, I've got everything, but I just can't afford a 650 or $700,000 starter home.
Mm-hmm.
I just can't
Mm-hmm.
do it. So
Yeah.
I'm never one, just like you are, Dwight. We're never one to say, oh, we need the government to help us. But I'm going to say it this time because they're the only ones with the pockets deep enough to do it.
I think we have an ongoing problem. And John, I call it the COVID hangover, right?
Mm.
I still think, here's what I think has happened. We got so disrupted during the COVID. Well, we got disrupted in 08, 09. Remember, we stopped building houses for
Yes.
5 or 6 years.
Right.
Then we had the COVID hangover where you had supply chain issues. You had COVID, people weren't showing up, all these things. Do you think that these companies, out there, I'm even talking the plumbing companies, the electrical, are they just now trying to put money back into where they've lost it all? I don't see anybody adjusting their price points downward. Meaning, if you
they can't
no,
because
I
of material and
understand.
labor. They
Right,
can't do
right.
it, or they're going to be out of business.
And even if they had the opportunity to give a little, you got to save for a rainy day as well, right?
Sure.
If it costs me $3 and I charge you $3, I'm not making anything.
No, you're not going to stay in
So if I
business.
charge you $3.05, I'm making a couple. But I just think like you said, there's a systematic problem going on, and I do believe the government, with the size and the scope that it is, has probably the only ability. And I'm like you, I'm such an entrepreneur spirit, and I don't need the government in my back pocket,
No.
but they can create ways to assist and help in that. But John, I'll tell you, there's a local municipality in Northern Nevada that just raised their hookup fees. I think it was $17,000. And you're telling me that it went up $17,000?
Right.
That's the argument I would have. So if the communities want to assist, then it's the planning department, it's it's the public works
system.
Everybody's got to give a little bit to get in there. And if you could shave off, you start with $10,000 or $15,000 off of a house, that's at least in the right direction.
Sure.
But
sure.
I just don't know. It doesn't feel like there's a lot, in my humble opinion, it doesn't feel like there's a lot of effort around that solution.
Zero effort.
So now everybody's going, okay, let's let the government do it. And that's,
there's zero effort.
So,
and the home
exactly.
builders, frankly, they love it, right? Because they're able to charge more. But again, that's going to come to a point at some point where no matter how low rates get, again, you can offer me a 3% mortgage, but if now my homes are, and this is going to be the downside of lower interest rates, Dwight. If let's say the home is 700,000 a day, and let's say we could get back, I'm not saying it's going to happen, but let's say we could get back to a 3% mortgage, a 4% mortgage, even a 5% mortgage, doggone well, the way the system always works is generally you're going to see that $700,000 home go up to 750 or 8 or somewhere else.
Yes.
So I, as a potential borrower, I didn't get anywhere. I didn't benefit from lower rates because I still can't get in. And that's why I keep coming back to, it's got to start with the affordability issue.
John, and I haven't met a national home builder yet that's slowing down yet.
No,
they're
not
building
at all.
specs.
Not at
Yeah.
all.
So, their mentality is we build it, they'll come.
That's right.
We may have to do
Supply
some incentives now. We may have to do some things, but you're right. You create more of an inventory, then you're going to get a supply and demand issue.
Yes.
And the home prices, you get 3 or 4 offers on the same house. Pretty soon there's sellers, buyers.
Yes.
The sellers, whether they're builders or whatever, are going to go ahead and elevate those prices to get the supply and demand issue.
Right.
So
absolutely.
Not an easy solution.
No, there really isn't. All right, let me tell you what happened in the market today, and before we go to break, because it was an incredible day today. What kind of day was it today, Dwight?
It was another record-setting day, John. I love it.
There you go. You're sounding so good saying that. Not just of one major indice, but 3. It was a trifecta. Dow, NASDAQ, S&P closing at record levels. Why? Because of the report we'll go over when we come back, and that is the inflationary report, the CPI data. But it was an amazing day. Again, this is the second time this week that we've had all 3 major averages close at record levels, right? Yesterday was the NASDAQ and the S&P. The Dow faltered a little over 200 points, but not today. It just ripped and ripped and ripped and just really never seemed to look back. It just kept going up and up and up, and they couldn't stop the momentum of it. You could see the algorithm stepping in and buying, and then we had some really strong performance of a few major NASDAQ names that drove the NASDAQ higher. And again, the S&P, which has a lot of those major companies of the Dow, et cetera, in there, they moved higher. And it really was an amazing day to watch and see how this market just took off. And Dwight, it's scary from the standpoint, as we're going to get into when we come back, in regards to next Wednesday and the anticipation of, and I'll tell everybody what the probability is at this point, the anticipation of a 0.25% cut. And, literally, Dwight, as we continue to have these stronger days in the market, and today, as I'll cover, we had a weak labor report, the initial jobless claims number. And so this market really at this point is going, bad news is good news. Bad news is good news. Labor market weakening. Yay. That's great news. Fewer people working. Yay. Great news.
Yeah.
Again, I know for most people are like, has this guy lost his mind? But that's the way, Wall Street is looking at it. Others are going, yay, the Fed's going to cut rates. That means there's some problems in the economy. And oh, by the way, yay, because it may be a 0.5% cut now. There's a lot of prominent people coming out going, no, the Fed should have cut last meeting. So therefore they got to catch up and they need to do another one. So don't do a 0.25%, do a 0.5%. And you and I have said over and over again, no, please don't do a 0.5%. That could cause panic in this market. So we're just in a really interesting dynamic of not only my world, but also your world. So we got a lot of things to talk about. Let's turn it over to Jack Saban first. He's in the Right Now Traffic Center. Hey, Jack. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of Highlands Mortgage. Corey again has the afternoon off. All right, we're talking about a trifecta record-setting day today. Let's cover the numbers. 617 gain on the Dow, 1.36%. 46,108 was our close. NASDAQ up 157.72% to 22,043. S&P up 55 points or 0.85%, closing at 6,587. Once again, our topic, low rates are still here, or low rates are coming, but this isn't going to be the solution to the housing market. We're going to get into the details why. Let's go to the commodities. Pull back a nice on oil. It's going to feel good at the pump if this holds. $1.31 loss, $62.36 a barrel. Gold down $8.16, $3,633.80 an ounce. And just a 2 basis point decline on the 10-year Treasury at a yield of 3.4%. All right, Dwight, before I get to the CPI report, let's take it away on the mortgage side.
Yeah, beautiful day, John, and a beautiful trend we've got going. So according to Mortgage News Daily, which we follow, 6.27, John, on the 30-year fixed rate. Let me give you some perspective on that. January of just this year, January 13th, we were 7.16. May 19th of this year, we were at 7.03, so still well above the 7% mark. And here we are at 6.27, so almost a full 100 basis point drop. We're getting closer. But if you let's flash back a year ago, September 16th, Monday. Remember Monday, we were at 6.15, John. And, we know what happened. They raised it a 0.5 point on the 18th, and we saw rates do nothing, to your point, almost breached in the 8s, remember, in the end of last year. So I'm really praying that they don't go with that 0.5 point again. I think, I'd rather them be encouraging that there's more to come versus, hey, let's do it.
Right. Agree.
Yeah, I'd rather them feel good. Yeah, I'd rather them feel good that they can do another quarter maybe
well, look,
next.
Dwight, it's worked, right? They've been dangling the carrot for seriously the last 2 to 3 months. And look with the stock market, where, again, record levels and rates have come down. So, I would rather, I love that term. Yeah, dangle further cuts and not give it all to us at once. But folks, let me tell you, let me bring you up to date. Let me transition, Dwight, right now into, where we sit on the probability side of things. So according to the CME Fed Watch tool, there's now a 92.4% probability of at least a 0.25% cut at the October meeting. So let me rephrase that.
Wow.
At the October meeting, 92% probability.
I still stand by my 3/4 this year.
Yeah, I think you may be right. Yesterday there was a different number. Yesterday, that probability was 86.2%. Okay, so it dropped a little bit. And there is now I'm sorry, I'm getting twisted up here. Let me back up. Okay, so 92.4% probability of a 0.25% at the October meeting versus 80.9% yesterday. Okay, so there we go. So we did drop pretty substantially there. Now, there's an 86.2% probability, Dwight, of at least a 0.25% cut at the December meeting versus 74.5% yesterday. So that probability increased nicely of the December meeting, came down a little bit for the October meeting. And again, the street right now is close to 100% as you can get is what it has priced in for the October meeting, September meeting. So again, to reiterate what you and I want, a quarter percent at the for the rest of this year. I think that would be beautiful. I think it will just be amazing for the stock market, amazing for the real estate, mortgages, etc. 0.5% for those of you that may be new to the show or new to the markets and don't know how interest rates affect things. You do a 0.5%. The reason Dwight and I keep saying don't do a 0.5%. It could project panic. It could be, what does the Fed see happening, lurking behind the dark corners of the economy that that makes them jump all the way up to a 0.5%. So that's going to be an interesting one. We'll see. Of course, next Wednesday will be the big day.
John, and we're flirting with at least 50, 55, maybe 60 basis points in the movement just on the anticipation of the quarter.
Yes.
So you get through this one, you get another quarter.
That's
now you're going to be looking
saying.
at the high fives.
That's
you get another one, your mid fives, maybe a 5.3, 5.2 by the end of the year.
Yep. That's right.
Which is, I think if we go back to the tape, I probably predicted 5.25 by the end of the year.
I think you may be right on that.
I think I might be right.
What did I say? I don't even remember. Or did I?
I think you were still in the low sixes.
Low sixes, yeah. I think 6.25, somewhere around there. Yeah. Okay. Hey, you know what?
You might be right. We're not thinking you might be right.
Here we are, September. We're at 6.25. Okay. So, yeah, we will say.
But great news on the 15, though, John. I mean, you're well.
Yeah, let's go over that real quick.
Now.
I'm glad you brought that up.
Yeah, I don't have that up right now.
Yeah, 570. 570. Yeah, unchanged on the day.
Yeah.
5.7 on the 15.
Your government's in the fives.
Look great too. 30-year FHA 5.97, down 2 basis points for the day. 30-year VA 5.99, just broke that 6%. Also down 2 basis points for the day in the 30-year.
What's really impactful, John, is like you said, we haven't seen this for almost a year. But the problem is we only saw it briefly a year ago. Remember, we barely came down.
We got a taste of it.
We got it. Yeah, and so nobody could react to it. Now it feels like the momentum is on the downward trend.
Very much.
So they can actually maybe now feel secure about taking advantage of it. There,
right.
Just remember it bottomed and jumped.
Yep.
Remember it just bottomed and jumped.
Yep.
So this feels a lot better, and I think more momentum for people in the downward.
Yes, exactly. All right, let's real quickly before we go to break, let's bring everybody up to date on the inflation side of things today. So yesterday, of course, we had PPI, the measure of inflation wholesale. Today was the retail, the CPI number. And here's how the numbers worked out. We came in up 0.4% month over month. They were expecting a 0.3%. So that part was a little bit bad. Year over year, we're up about 2.9. The core was a match, up 0.3%, right in line with expectation. Core, again, strip out food and energy, up 3.1. So kind of mixed reports, not the greatest, showed a little bit of an uptick there, which is bizarre because like Jason and I mentioned on the show yesterday, you get the PPI, right? It starts the wholesale side with the retailer, we'll call it. And again, that number was below expectation, which means CPI should be coming down. And we saw just the opposite. So the final goods, the CPI, that number bumped up. So that tells me that retailers are not getting hit too bad on the tariff side of things, but yet they are able to bump up their prices, making the public think, oh, yeah, I know my widget now is $5 and when before it used to be $4.80 because this poor retailer is having to pay 20 cents in tariffs. That is not showing that at this point. So
they're holding their price points, John,
holding their price points, which is Wall Street loves, because that revolves.
Didn't a couple companies, large ones, get caught with that?
Yeah. Oh, yeah.
Hey, we're blaming it on tariffs and had nothing to do with tariffs.
Absolutely.
So this will take probably a little time to flush out.
It will. Yep. So we had that. Now the weak side of things, the labor front, again, it's Thursday. So we had initial claims check-in, first time filing for state unemployment benefit. And that number shot up, Dwight, 27,000 filings to 263,000. That number's been moving up. We were stuck around 210, 220 for months upon months. And slowly but surely it's starting to edge up. And this coincides with last Friday's non-farm payroll number when we only showed 22,000 jobs created. The labor market, I can't stress it enough, is slowing down, but employers, they're holding on to the people. They're not getting rid of them. They're holding on, but they're definitely not hiring. So I'd love to get your perspective of what you're seeing, talking to your clients as far as job stability and that type of thing. All right, when we come back, we're going to get into the big problem with the housing market. Not the rates any longer, but this thing called affordability. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hey, Jack. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of Highlands Mortgage. Once again, Corey has the afternoon off. We finished with a record-setting day for the Dow, the NASDAQ, and the S&P. Dow rose 617, NASDAQ up 157, S&P for the day up 55 points. All right, we're going to get into our topic right now, which is there's still a problem with the housing market, right? We spent pretty much the first half of the show talking about mortgage rates slowly but surely starting to come down, the anticipation of further interest rate cuts this year. And remember, just a real basic thing, remember, folks, this, even though the Fed, if they cut rates as anticipated, next week and then maybe 2 more this year, that is the Fed funds rate. That is the rate that banks charge one another to borrow money. It has nothing to do with the bond market. It has nothing to do with the stock market, or most importantly, has nothing to do with mortgage rates, right? Completely different animals. But everybody looks at that and goes, oh, okay, if the Fed funds rate is lower, guess what? Now we should start cutting our rates on mortgages and credit cards and a few other things that are out there. But I want to go back one more time to Dwight's point. Last time we got a 1/4 or 0.5% cut, the market freaked out and bond rates shot up and mortgage rates shot up, right? So there is no guarantee that if the Fed cuts rates, I know I've said this, I don't know, I've lost count recently, but there's no guarantee that if the Fed cuts rates, you're going to see a direct relation or any type of relation with mortgage rates, because again, these are different bonds, and we'll have another show on that mechanics of what creates mortgage rates. But we just want to get that point out there. But beyond that, let's be optimistic. Let's hope that we do get 0.75% cuts, as we said going into the break, Dwight. We still have another major issue going on, and that is the affordability. And we spent some time at the beginning of the show talking about potential solutions. And again, that's a whole nother show we can do. But let's kind of bring everybody up to date on where we sit at this point in the borrower, the potential homeowner's mind right now, Dwight, when it comes to the qualification standpoint. So nobody better to tell us than you.
Yeah.
What are you seeing with people coming into your office? And then we're going to get into some details.
Well, I think you see a little bit of optimism right now, but it's cautious optimism that, hey, maybe I can get, but John, in this article that you sent out, I mean, home prices are up 50% since 2019. I don't even know if I realized that, right?
I know I didn't until this.
Yeah. So people are challenged with this, but what I'm hearing more and more, if they don't have a credit issue, then they're concerned about the ongoing employment and income issue. The last thing you want to do in a scenario is throw this term, and this is the first time we use this, variable income. So if you can't show me consistent income, like you have a 40-hour job and blah, 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 traveling nurses are guilty, not guilty, but they fall into this. Where you have odd income, it's variable. When you get into variable income, it gets very, very sketchy about how you can identify income and can throw a lot of people out of qualifying. So you're starting to see a little bit of that movement, right? Because people are getting cut back a little bit. Hey, I need to move you to 35 hours this week. I need to, because to your point, nobody's getting rid of anybody. Nobody's getting rid of anybody right now.
I got a taste of that when I went to South Carolina. Sorry to interrupt you. We had to take an Uber a couple of times. We rented a car, but we took an Uber a couple of times. And I was talking to this one kid that brought us back from dinner Friday night, and real good looking kid, great personality, and probably 26, 28 years old. Hey, what do you do for a living? Oh, I work in my family's apartment maintenance business, growing business. We're slam, blah, blah, blah. I'm thinking, well, why are you driving Uber? And it was exactly that. He said, I'm trying to save for a down payment to buy my first house. Right. And I think you could probably do a survey of, 1,000 Uber drivers, and I think you're going to find that a lot I'll just use the term, the gig economy, right? This is how they can get ahead, because again, we all know, even if you're making 75 or 100 grand, you're probably able to pay your bills, but you're not able to get ahead and get that 20% down payment. Let's run a scenario here, Dwight. So talking about, again, how important rates are, but really affordability is the biggest issue. So if you're a home buyer with a $3,000 monthly housing budget, you can afford to buy a $466,000 home at about 6.35% mortgage rate. Okay. And once again, we're 627 today, 6.27. Okay. But that assumes a 20% down payment. So you're talking almost $100,000 down payment, right? At a 466 purchase price. Very difficult for people to save that amount of money. Now, this is according to Redfin. Now, at a 7% rate, that buyer that could afford or qualify for that $466,000 home, again at 6.35, at a 7% mortgage, he can only qualify, or she, for $442,500. So, you're talking $26,000 difference, just with a slight decrease in that mortgage rate, or a slight increase, 7% down to 6.35. So every downtick, right, Dwight, is going to help in the qualifying process. But no, I love this comment from Mark Fleming. He's the chief economist at First American Financial, which is a massive title insurance company. He said, quote, there's no mortgage rate in the foreseeable future that would change the affordability scenario significantly. I think, we all understand that. Dwight, I love watching every Wednesday. We get the mortgage application data for the week ending September the 5th. Mortgage apps were up 22% from a year earlier. That's the highest level that we've seen going back to July, according to the Mortgage Bankers Association. So we know there's a lot of people sitting out there just waiting for every little downtick possible on the interest rate side of things. But the bigger picture, back to the affordability issue, like you said, home prices are up 50% since 2019. And to my stat, approximately 13% of U.S. renter households could afford to buy a median price home in the second quarter of this year. That is down from 17% in 2019, right? There's that 2019 correlation. And that's according to the brokerage firm CBRE. So we're all looking at that. And then the final comment I want to make, and I'm going to turn it over to you, is Huntington Bancshares, their chief financial officer, said he doesn't expect any significant wave of activity soon. He says lower rates will help stimulate an incremental pickup in the market. He said, but there's still a major challenge, such as a tight supply in many parts of the country. Okay, we got the stats, but Dwight, there's no better way for everybody to learn what's going on than you.
Well,
how are you helping people at this point? Because again, no one can control affordability.
Well, John, I think what's happening is we're creating trigger points. You understand that in the ERA world, when it hits this price. So the reason why I think applications went up so fast is these builders are all keeping cards, hey, what would make you, and everybody now has information on what rates are doing, right? Everybody, every community manager, every realtor. And so what they're doing is the moment it starts to go down, they're calling and saying, hey, it hit where you want, we got 25 basis point lower. These people are coming in and going into application. Now, it'll be interesting to see if they're going into contracts or just, hey, I'm ready. I'm poising myself to be ready if they come down. But I think you're starting to see some good activity because it's getting a lot of good press. People have,
yes.
We've always talked about, they've got more information available to them now than they've ever had. So they're seeing what the difference are in payments. So I wanted to just share with you real quick. I ran a scenario similar to that. I took 6.25. Okay. I just took a 550 in Reno. Let's just say 550 median home price, just 10% down. Just P&I is all I did, principal and interest. On a 6.25, the payment's $3,048. Okay. If you go to 5, so if you get a 1.25 relief, the payment is $2,657.
Wow.
First of all, mental barrier, right? You're from 3,000 now in the 2000s. So it's a difference of $391. Let's just round up $400. That's a lot in people's budget.
$4,800 a year.
Yeah. That's a lot in people. So it will have an effect, John, but I don't know that's going to be the culprit to get the people who don't really need, they're comfortable renting right now. I don't know if it's going to motivate them. It might motivate, a couple to sell their house to get closer to their grandkids, those type of scenarios, life scenarios. But if I'm sitting and I'm okay, my rent's okay, I'm kind of throwing money away on a rent, maybe, I still don't really have to make a move. I don't know that this is going to do it for me.
Agreed.
I think I'm going to wait till next. Well, and John, there's another thing. You don't think these apartment complex see what rates are doing? They're trying to lock people into 2 years, John. They're trying to lock them into 2 years now, because they know if they start to see rates, they might lose these quality. You don't want to lose a quality tenant over to a homeowner. I mean,
no, you're right.
There's a lot of it's the baseball game, right? There's a game inside the game, right? And that's what's going on now. Everybody's dialing for dollars. Everybody's trying to figure out how to hold theirs and how to create activity.
Yep, love it. All right, we'll continue our discussion on home affordability. Let's wrap it up with Jack Saban right now. Traffic Center. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of Highlands Mortgage, of which please give us your phone number, Mr. Millard.
Yes, sir.
Thank you, sir. Do appreciate it. All right. We've been talking again about lower rates, the anticipation if the Fed gives us the interest rate cut next week, and then maybe a couple more the rest of the year. And who knows, Dwight, I haven't seen any real valid predictions for 2026, but, generally the Fed will start cutting and get into an interest rate cutting cycle until something reverses that, right? So,
we do know there'll be a new sheriff in town.
Yep. That's exactly right.
In May.
Sure will be. Meaning the Federal Reserve Chairman, Mr. Powell, will be out of a job come April or May, I guess it is.
Wouldn't that shock you if he got
Well, he legally, what they're saying at least, is he can stay. He's a member of the board of
Right.
governors, right?
So he can
And he
stay
can
on.
stay on. Yeah, he can stay on, but who knows if he's going to. Okay, now we got a couple minutes, Dwight. We've laid out the problems, affordability. What are some of the solutions for people that want to come in and see you or any mortgage professional to start getting this ball rolling, right? They're ready. Rates are coming down. All right, let's move. What do we
Let's
need
help
to be
yourself
thinking
out,
about? Let's
right?
help it.
Let's
Yep.
help yourself out. Yeah.
Yep.
Well, John, first of all, credit score, right? We've talked about this. I'll preach it till my grave, right? Keep your credit score elevated. Do everything you can to make sure you've got the highest credit score available, because that's going to drive your base rate, right? And so you're going with your best credit score is going to be helpful in obtaining a favorable interest rate out of the gate. The other thing that's going to help you, and I say this is more impactful than anything else, is keep your debt level manageable. Keep it minimal, keep it manageable. I know I see a lot of student loans out there, John. They're pretty decent payments, so don't worry about trying to, but just don't get heavy on big car payments, Visas,
Which is so hard not to.
Yeah, which is hard not to, especially if you get in that cycle. But find a way to get to a more manageable debt load. So credit scores and debt load.
Okay, so let's give some targets here. So let's go back to the credit score. You want that target north of 720?
God, I would love to have, even north of 700 helps you in a lot of cases. You get perfect. 720, 730, 40. You're getting up there. So
okay,
that's
excellent.
Yeah.
All right, so there's our target there. Our debt to income ratio, where you want to see us there, and how do you calculate that?
So the debt to income that reflects your true debt is your bottom ratio number, and we can go as high as a 49, right? Over a 50 for government. That's way too high for somebody to feel comfortable. Even though I can get you approved, you're not going to be comfortable making the payment. So get that somewhere down the 42, 43 range, maybe even 40. That's your total. That's your house payment plus all your other fixed debt that we know about. I don't know about your health care. I don't know about your.
So we're talking, okay, this is important. We're talking really personally, right? So take all of your bills divided by your net income. I don't give a darn about your gross. You calculate it differently to qualify. But in reality, like you said, I've got to feel comfortable with this mortgage because I can't control the price of the house. So where do you want to see that? 20, 30% overall?
No, I think if you take all your debt, I think if you can stay somewhere south of 45 DTI, I mean, all your debt that I don't know about, your child care, all that stuff, I think you're in good shape there.
Okay.
Yeah.
Okay. Very good.
Yeah.
Well, it is a challenge. It is something that you have to continue to work on. If this is your dream to get your first home or move up to a bigger home, you got to follow these rules of advice that Dwight laid out. Dwight, one more time, phone number.
Yeah.
Perfect. And don't forget, Dwight can take a look at your credit without a big hit to your report and help you get that score up. Take advantage of that offer. Great job, buddy. Great seeing you. God bless everybody. We'll see you tomorrow on the Jon Sanchez Show.